Hi, it's Jeffrey Cohen, Chicago Quantum. How are you? Just a quick video. Going to talk about a tale of two markets. So what we're noticing in the market, and we'll have to explain it all to you, it's fine, is that the expected return in the market is down. So people are not investing, speculating, as if the markets are going to shoot straight up higher. Now, for those who are in the market, you kind of get it. You know that. You're like, oh yeah, Jeff, teach me something I don't know. But for those who don't know, the market is not behaving in an aggressive upward manner. The market is choppy. And we'll talk about it. The market's not going up. It's not going down. It's choppy. It moves a little, but not a lot. And so there's a question for you. Is a choppy market a good market? And so our core investing principle is that you should invest in a way that isn't very risky. You should reduce your risk in the market. Okay, I can buy that. Why is that? I thought with no risk, no return. Risk makes you money. No. Risk is a required precondition for most investments to make money. But if you can reduce your risk, you want to do that. Make all the money, reduce the risk. All right. Kind of like Captain Obvious here. But let's just lay this out because not everyone who watches the videos is into markets. And so reduce my risk, get the most expected return I can. So what happens when the market has less risk? So stocks, lately, the risk is going down. Okay, that's cool. Less risk. The expected return is going down. Oh, that's not good. So what's going on? Well, what happens is it's kind of like when you throw a ball in the air. Let's see if I can find a picture of that. Trajectory of a ball. Let's try. I'm just guessing here. I'm looking for a picture. Here it is. So similar to volatility, the drag on the ball. So you see this V? So what happens is you reach a flat point. And what's happening in the model is you're reaching more of a flat trajectory, more of a calming down of stocks, a lower variance, a lower volatility, which is great. But we're also seeing a reduction in expected returns, which is not great. So the question is, where are we headed, right? It's a tale of two markets here because one side of the coin says less risk, and the other side says less return. So where should your money be, right? And that's what I'm going to talk about. That's the whole point of this video. So if we take a look at the S&P 500, of course it's up 0.05% because, this market really isn't moving much. So we're going to look at it daily. And this was my old regression line that I put in from a video from a year ago. So let's continue the curve. Oh, look. It actually looks even flatter. Slightly down, but even flatter than it does. So this is not a market that has a sense of direction. This is a market that is consolidating. It's choppy. It's not moving. So what do you do? What do you do if you're in this market, and by the way, and you're above the regression line? If you believe the market's going to stay flat the way it is, you want to sell right now. You want to be thankful if you've got stocks that are up and you want them out. You want to get out. You want to get out. You want to let the market can kind of continue back on its curve. If you look, sometimes this is hard to see, but we're going to try. We're going to zoom right in, okay, to the last 3 weeks. And you see the S&P 500, we're going to try to draw a regression line. And we'll make it a trend line. I don't know that it's any different, but it's fine. A nice, thick trend line. And you're like, hey, market's going up. This is great. I got a good positive trend. But if you look at the stochastics, the momentum indicators, you can see the momentum is down. Right there. Right there in the last 2 days. The momentum is down. If you see the accumulation in the market ended April 3rd. Since April 3rd, you've only had one accumulation day. The rest is distribution. Even on the up days, the S&P 500 has been in distribution mode. So you should be asking yourself, what does this mean? I don't know. It can't be good though, right? It means market is kind of trending lower. The expectation is lower. I think I've sold you that, okay? Variance. How do I show you variance? The only way I know how to show you variance. And by the way, some of you are probably wondering, what are those NASDAQ book viewer pages? And I'm glad that you asked. So I am tracking Corbis. Now, many of you know that I was a big fan of Corbis. And I'm not sure if you're aware of the fact, but my wash sale period is over with Corbis. I could buy as much as I want right now. And I'm watching it at $9 a share, and I'm thinking, wow, I love that stock. Do you know that they made a deal with a Chinese pharmaceutical company which catapulted their cancer pipeline to a whole new level? Now, they paid a lot of money to do so. So the question is, was it a good deal or not? But that stock, I sold it at $7.19. It's at $9.13. The stock is up $2 since I sold it. It's just very interesting. I don't have a point of view on Corbis. I just know it. I'm also tracking Atlas Lithium. So Atlas Lithium is a tremendous opportunity for dreamers. It is a future vision kind of a stock. It says early stage pre-production lithium mining rights in Central America, South America. And what do you think? What do you think? I'm following this. I've been following it since like $6 a share. It's now $28.75. Interesting. Lumen. I've been doing due diligence on Lumen. You know, yesterday the thing traded as low as like 209. It's at 223. It's up 14 cents since I scratched my head and sent a tweet out that says, wow, new lows. It's up 7% in a day. I don't know. Lumen is a very interesting business. You know, they bought Level 3. They're refinancing their debts. They're pushing out the maturity dates, increasing the coupon rate and making them secured versus not unsecured. Senior unsecured to secured. Higher coupon rate. Pushed out the maturity. It buys them time. It's interesting, Lumen. And then you got ATI Physical Therapy, which we are long ATI Physical Therapy. We have a long position. We do not have any long positions on the others or short positions. We are long ATI Physical Therapy. We love ATI Physical Therapy. We just posted on ATI Physical Therapy's Yahoo posting a balanced but factual rationale for our investment in ATI Physical Therapy. I love it. Love the stock, love the company, love the story. It's a good story. We are long ATI Physical Therapy, and we're very excited about the stock and the opportunity to invest even more in that stock. So I watch it. I watch it like a hawk. Why not? I also watch Atlas Lithium. And same thing. I'm watching it. I'm very curious to see what it does. And, I plan on having some updates for you guys. So let's talk about what's going on with the stocks. So I lost a little focus there. It's not my fault. I get very excited about ATI Physical Therapy. I think it's a great stock. Great stock. So, but I don't know that I recommend you buying it. I think you shouldn't buy it. In fact, don't buy ATI Physical Therapy. Let someone else buy it. I wouldn't buy it. Now, I'm buying it, but if I were you, I'd stay away from it. It's no good for you. I don't like it. I don't like it. I say you're out. Okay? So, here's our model on the left-hand side. And here's the spreadsheet on the right-hand side. So the spreadsheet on the right-hand side, I'm going to make it bigger for y'all. Now this is telling you a story here that I think you need to see. It says, what's the best stock? It's the S&P 500, ETF. Now that's good actually, because what that's telling you is that the model is calibrated correctly. It should be the best stock. It's all stocks. It's great. It's a very effective, efficient portfolio. Now, if you look next to it, you got your high yield corporate bond ETF. Now, negative means better. Negative means better than all the stocks, because all the stocks by definition are basically balanced. And so all the stocks are balanced to minus 2.7 times 10 to the 20th. And so that's 0 within rounding error. So this is nice. Berkshire Hathaway, right? Better than most. Now, you're not surprised. P&M Resources, we've talked a lot about that. That's New Mexico's regulated utility. But there's some surprises in here. There's the dollar bullish bet. There's the Russell, the NASDAQ, and the S&P 500, which are not surprising. There's the 1 to 3 year Treasury bond ETF, the SHI. Now that's interesting. And then there's the high yield corporate bond. So what that says is if you were only going to buy one stock today, let's say you got paid. You got an extra $500. Got the S&P 500. Always a good idea. You put your next 500 into some high yield corporate bonds. For each decision, if you only could buy one stock, then maybe you got the NASDAQ. Now, the S&P 500 is best. High yield corporate bonds, NASDAQ, 1 to 3 year Treasury bonds, all about the same risk return. Okay, and they're all a little bit better. Then you got the Russell, probably a little more high risk. We could actually check that. Yeah, on the Russell, it's expecting to earn a little more. You get a little more bang for your buck on the Russell, but you get a little more variance. It's like with the high yield, right? The NASDAQ, the Russell, the high yields, a little more risk, a little more return. That's why you do it. So you look at that and you think, all right, Jeff, but what am I getting, right? Like the best answer here is 0.00001. Or 1 times 10 to the negative 1 times 10 to the negative 5th. And I gotta say, that's not that exciting. Jeffrey, that's not much edge. You'd be better off. I mean, the S&P 500 versus itself, but the S&P 500 versus all the stocks, it says not much edge. So what that says to me is you're calibrated right, maybe you could add a tiny bit of risk, but maybe not. And so, all right, I'm feeling good about this. The model is calibrated. Now, what does that mean? So what we've done, I just want you to see this for a minute. I get a lot of questions on what does it mean to be risk on, risk off. I make videos, whatever, but here's where it gets interesting. The risk-free rate of return out there for you, for me, is 5%. I left it at 5.1. It's actually 5.0 because it changes every day. And so if I were to go and look at the 13-week Treasury, you'd be at 4.95 yield. But I could go to a different page, which is a different futures pricing. And the U.S. 3-month Treasury bill future is trading at 5.09, which is very close to 5.1, which means you buy the future, it's fine. Now, if you went to treasurydirect.gov, by the way, if you actually want to know what the yields are right now, you don't even have to log in. Take a look at the auction results. Take a look at today's auction results. Were there any? Not notes, bills, short-term money, 13-week money. All right, we're going to take a look at on the 20th that traded yesterday. Okay, this is the announcement. Hang on a second, please. Got to find it. Yeah, we can't. We have to go to the 13th. The actual results. One more time. Here you go. If you would have bought 13-week treasuries and you would have bought them on April 13, the median rate's 5%. The median rate is up and down, up and down. So it's the median rate. Now, the high rate at which you still got paid was 5.08. The investment rate was 5.23. So you would have earned 5.25 if you would have bid for the 13-week treasuries. Now, like most of us, you're not big enough to bid competitively. So you bid non-competitively, you probably would have gotten 5 1/8 as opposed to 5 1/4, and you still would be making a banking a boatload of money. So I'm just trying to justify why we have a risk-free rate of return of 5.1. Now, on the other hand, what's the dividend yield? The dividend yield of the S&P 500, which is a pretty darn good proxy, if you would have bought the S&P 500 every single day last year and held it, your actual yield would be 1.63%. Our dividend yield is 1.63%. Our capital appreciation rate is 7%. So how many of you are out there trying to earn 7% on your stocks? My guess is not that many. Because you could go right to savings bonds, I-Series, and earn 6.9 with no risk. I just gotta say, I love it. You can earn 7% on your savings bonds. You can earn 7% in the stock market. Now you could argue that the market is a little off and maybe it's 7 1/4, and it's fine. You're not going to get much out of me here. So risk-free return is 5.1. Market index floor returns are 7% capital appreciation, a 1.63% dividend. And you can see that all of the exchanges, all of the indices are down for the year. The Spider's down almost 6%, excluding dividends. The Russell's down 10%. The QQQ, or the NASDAQ 100, is down 6%. Again, all excluding dividends. You know that the S&P 500 dividend is 1.63%, so you're really down like 4.3. IWM is a much lower dividend, so it's under 1, so you're down at least 9. NASDAQ, same thing, you're down at least 5. Jeff, this is exhausting. So where do I go? What do I invest in? Jeffrey, it's a tale of two markets. On one hand, get the heck out of the stock market. I'm earning the same 7% in I bonds, and I'm earning 5.25% if I'm big money, 5.25% if I'm big money in treasuries. Why do I want 7%? Well, you don't. You don't. But here's where it gets interesting. Because the riskiness of the stock market has dropped, because the variance of the stock market is at 6.44 times 10 to the negative 5, and the variance is 4.0 times 10 to the negative 5 for the S&P 500, and because that's trending lower, you're getting a little more bang for your buck here. So, Jeffrey, tell me what I should buy. Where am I going with this? So where you're going with this is you could have a lot of edge right now on 4, 5, or 6 stocks. Edge, real alpha edge, more return versus risk. You're reaching for yield. You're reaching for return. And you're reaching in some of the riskiest names around right now. So I'm going to copy these and we're going to take a quick look at Yahoo Finance. I'm sorry, that note is not for you. This note is for you. I did some of God's work today. It was nice. Did some work on quantum computing. Paid work. It was helpful. It's nice to get a little paycheck once in a while. So these are the portfolios. This is the Chicago Quantum Net Score, and these are the stocks. And you're supposed to buy these stocks and hold them. Buy and hold equally. So that means a 5-stock portfolio equals 20% in each. Okay, I got it. Thank you, Jeffrey. Appreciate it. So without further ado, let's go take a look and see how they're doing. Now, what's interesting is we're going to go and we're going to create a portfolio of these 5 stocks. And maybe we'll just add a few, make it like the 6 or 7 stocks so that you can really see it. So I'm going to customize, I'm going to create a portfolio, and we're going to call this the Chicago Quantum Net Score April 20, 2023 long portfolio. And the question is, how did you do today? So you bought the run last night. You got this at around 8 o'clock at night. You did your due diligence, did your homework, and you bought them. Let's try. AFRM, Affirm Holdings. APPS, Digital Turbine. CBIO, Catalyst Biosciences. MSTR, MicroStrategy Incorporated. VHC. Virnex X Holding Corp. And we're going to add, just because it's showing up, ZIM, which is Zim Integrated Shipping. And we're going to add W, which is Wayfair. And we're going to add CENX. And that is effectively the superset of stocks that got you the top 6 portfolios. 8 stocks, top 6 portfolios. Now, if we take a look at where they are today, those stocks, it's so interesting. One's up 13%. Okay, I'm going to throw up a little bit here. One's down 8%. There's a lot of movement in these stocks. But in general, these stocks are not necessarily up. Now, if you look, if you can see on the screen, the S&P 500 appears to be peekabooing a little higher. There's actually a nice, I like to use FinViz for this. So FinViz says we're just creeping up. Not a lot, but we're creeping up a little bit above where we opened. And if you look at these stocks, you can see 3 up, 4 down. I'm sorry, 3 down, 4 up. And it looks like you would have made a little bit of money. Not a ton. So what this is saying is that the model's not wrong. The model is paying you a little. 1% maybe, 2% on the day. It's a living, right? But it's interesting because we look at the volumes being traded, and for the most part, the volumes are below what you'd expect. So it's a low volume day. It's a low conviction day. And yet you still would have made a few bucks buying these stocks. You know, it's interesting. So the market is actually risk on in the riskiest things that you could imagine. The market is risk on. Now let's take a look at the market caps. You can see with these stocks, the market caps range from 38 million, 9 million. $9 million market cap, right? To 4.1 billion. So it's an interesting, right? Interesting. In fact, if we were to just wrap it up here, your midpoint is about 2 billion. But you do have some small and you do have some high. And so the model is telling you risk off. The market's kind of telling you, risk on. The market's kind of telling you risk on. And then you have a choice to make, right? Do you believe it? It's very interesting when you look at this because you would have made some money, not a lot. So where are we? And Jeffrey, maybe you could summarize for us. What are the key takeaways of this video? Key takeaway number 1 is that the risk-free return is very high. Most of us should take advantage of it more than we are today. 2, the market is expected to return 8.63% over the next year based on our CQNS model. The third is the stocks out there are trading with lower volatility, which is price variance in our math, which means the Chicago Quantum Net Score model is risk on, and picking among 8 stocks. And the best portfolio for long investing today is 5 stocks. That's risk on. That's very risk on. And so it's weird. The strange insight is that lower market volatility is very good for stocks and suggests a risk-on positioning. And that's it. I want to thank you for watching. Nothing in here was a promotion. We are not trying to get you to become clients. We're not trying to get your money. Truthfully, I would love the chance to have new clients. I would love the chance to be able to run models for you and to help you understand where the pockets are, where the advantages are. But the reality is, most of you are going to watch this video and you're going to move on to the next thing. But for those who like the math behind the model and the math behind the markets, we're there for you. So have a great day in the market. Success in your trades. And take care. Jeffrey Cohen, Chicago Quantum, President and Founder.